Good afternoon, ladies and gentlemen. I'm Ardl, a student of PG and Securities Market from NISL, and it is with immense pleasure that I welcome all our esteemed paper presenters, chairs, discussant, and all participants to session 6 on Indian commodity markets. This session will be chaired by Naveen Sharma, and we have Dr. Tulsi Lingareddy ma'am as discussant. Now, I would like to take the opportunity to introduce the chair and discussant. Naveen Sharma, General Manager, SEBI, is our chair. Mr. Naveen Sharma joined SEBI in July 2002 as management trainee. His first posting was in Market Regulation Department, and since then, he has worked in Investigation Department, SEBI Local Office, Investment Management Department, and Commodity Derivatives Market Regulation Department. During his tenure in SEBI for the last 20 years, he has handled multiple work responsibilities like policy related to investment advisor, portfolio manager, and alternative investment funds, market regulatory issues, investigation cases on different subjects, insider trading, market manipulation, misconduct of market intermediaries, and also instrumental in setting up local office of SEBI at Pradhan. As of now, he is working on budget announcement to set up 4 exchanges in India. Our discussant Tulsi Lingareddy is the Deputy of the Department of Research and Space. Dr. Tulsi Lingareddy has over 18 years of professional experience encompassing the area including commodities, currencies, and fixed income market. She has held various responsible positions at reputable institutions such as Economic and Political Research Foundation, Multi-Commodity Exchange of India Limited, CNBC TV 18 Commodity Unit, and Clearing Corporation of India Limited. She has participated and presented research paper at various international and national conferences and events. She has also published numerous research articles in well-known referred journals and media. She is a dynamic partaker of various programs in the arena of commodities and other financial markets. She is an active member of a number of professional associations, Agriculture Economic Research Association India, Indian Society of Agriculture, etc. Before we begin the session, let us get over the guidelines. A total of 15 minutes will be allotted for paper presenters, upon completion of which a bell will be rung. Post this, 2 minutes will be allotted to the presenters to conclude. Follow this, 5 minutes of discussing remarks and additional 2 minutes for question and answer. I would like Honorable Chair Naveen Sharma sir to take the session forward.
Good afternoon, everyone. To begin with, I must honestly say when I got this opportunity of being here a couple of days back, I was very excited. Being part of the policy making team, it's always good to be interacting with people who are into research mode, because they give you apt analysis of how the numbers behave and what the numbers are tallying. So when these topics were given to us, I was expecting that when I'm going to interact with these participants, I'm definitely going to take away certain thoughts which will help me in making policy decisions as far as commodity derivatives markets are concerned. Though my favorite subject of gold exchange is not there, it's more specific to every part. And I must tell you that a lot of activities are happening in agri-commodities derivatives market as well. So looking forward from the presenters, just one request that please try to adhere to the timeline so that all of us have time to share our thoughts and give our views. That's the only point which I want to make, and I want to start the presentation. Before ma'am, you want to say something? Can we start the session, please? First, presenter. Yep.
I request the first presenter to come up on stage and present the presentation. Sonia Garg, Priyanka Rani. Sonia Garg is not present. Do we have them online?
Next.
So next we have Ipsita, Saishree, and Puja Padhi from Macroeconomic. Yes.
My auditor. A very good afternoon to all of you. The topic of my presentation is Are commodity futures sensitive to monetary and related macroeconomic variables? I'll start by introducing a little bit commodity markets. Now, commodities, specifically primary commodities, are the key resources or the building blocks of any economy. Now, however advanced an economy might be, but it needs an assured supply of primary commodities to sustain itself. Hence, any fluctuations in the price of primary commodities can be the source as well as the consequence of unanticipated economic events. Commodity futures are in that way very uniquely positioned in the financial market as they derive their underlying value from real or physical primary commodities. Now, commodity and macroeconomic factors share a two-way linkage. For example, first linkage is when there is an increase, supposedly there is an increase in commodity prices. It might sometimes lead to inflationary pressure on the economy. It increases the cost of production for the industry as they use them as raw materials that affects the profitability of the firms and the overall growth. Similarly, supposedly the macroeconomic environment changes in a country. Say money supply increases, then the overall investment goes up, IIP picks up, demand for the commodities go up, and hence the commodity price changes. Now, any kind of imbalance in these two feedback mechanisms can sometimes be undesirable for it. So, the government, specifically the central bank, sometimes takes policy measures to mitigate such imbalances. Short-term interest rate has emerged as a key variable of interest in this context because central banks across the globe use short-term interest rate to balance economic growth and price stability in an economy. Response of commodity prices to monetary policy is an important aspect of monetary transmission mechanism in the economy, especially commodity futures prices because they carry the inflation expectation and the expected spot prices in the future. The motivation for our study comes from the literature where we see that a similar study by Brownian talks about why it is this area is a source of concern because they believe that an efficient market usually reflects all the underlying economic fundamentals in our economy. But there have been continuous periods of disconnect sometimes due to potential non-fundamental factors like poor regulatory practices, imperfect rationality, consumer sentiment, etc. And these are sometimes difficult to explain based solely on the economic fundamentals. Similar things have also been observed in the commodity markets globally, where we see that there is an increased participation of financial investors in the commodity market. They have been moved with innovative financial products like swaps, exchange rate derivatives, options, etc. And slowly we have seen that commodities have transformed from a physical to a financial asset in terms of their pricing behavior. Now, this can be of important consequences in the real economy because booms and busts can sometimes have very undesirable impacts on the economy. Hence, it is important concern for the policymakers, irrespective of the source, to see that whether commodity futures are sensitive to policy decisions and macroeconomic factors in an economy. So, our objective stems from our motivation. We want to see whether shocks in monetary policy variables and other relevant macroeconomic variables explain the variance of commodity future prices in India. So, we will first confirm the presence of the will first confirm that whether they explain the variance in commodity prices, we'll analyze the direction and magnitude of the responses. Then we also verify if commodity futures within and across the groups responding in unison to the commodity shocks. And we also shed light on the economic source of price volatility for each of the commodity futures. Now, if we look into the literature, I'll just breeze through it briefly. We see that there have been a large strand of literature to talk about the connection between the monetary policy and the commodity future prices because they can have either contractionary and expansionary effect on the economic conditions. Here, we also look largely into a very popular theory called Overshooting Theory given by Frankel in 1986 and 2014 regarding this relationship. Now, they propose an inverse relationship between the commodity futures and the monetary and the interest rate because they say that if interest rate in an economy increases, then opportunity costs for the investors also increases. The production decision of the firms differs because now financing becomes costlier and holding physical storage of commodity becomes costlier. Sometimes investors also shift into other markets in search of more profitability. Hence, the commodity prices decline until a point they are undervalued and investors are attracted to come back and make profit. There have been a few contrary studies also who say that there can be positive relation also in between the interest rate and the commodity futures via the inflation expectation which are built into the commodity futures when they are low. But those are very few in number and largely we see that the first one is more prevalent in the literature. Now, a prominent literature gap here is we see there are very few comprehensive empirical analysis in the landscape of Indian commodity market. Most studies are specific to either oil prices or gold prices. One of the studies that we have come across is Mo et al. Who have discussed about this and they confirm that there is an impact of macroeconomic information on the volatility of commodity futures in India. Now, we use individual commodity futures across three groups, that is industrial metals, precious metals, and energy, so that any idiosyncratic factors aren't potentially masked as they are in the broad multi-commodity. So the data is monthly data for generally commodity futures for 5 base metals, for 2 precious metals, and 2 energy commodities. And based on extensive literature review, we have zeroed in on 5 macroeconomic variables: wholesale price index, index of industrial production, weighted average call rate as the proxy for interest rate, money supply for liquidity, and real effective exchange rate. Time period is 2006 to 2019. Now, for the economic model, we use the structural vector autoregression, which has been extensively used in the literature for such kind of analysis, where it helps us to access the instantaneous links between the endogenous variables, in this case, the response of the commodity futures to any structural innovations in the macroeconomic variables. Our model is just identified. It is used with help of maximum likelihood estimator. All the black criteria are in place, which we call test. Then we have majorly derived analysis from the variance decomposition, but we have also presented the result of IRF and the coefficients. Now, a very important part of the structural bar model is that we have to impose identifying restrictions, as in, to say in simpler terms, how are the variables ordered in that particular system. Now, for that, we didn't want to restrict to one, so we chose two kinds of identified restrictions. First one is mostly based on the recent literature, where they assume that commodity future prices are assumed to respond to all sources of macroeconomic shocks simultaneously, whereas it's not, the reverse is not. Now, the second identifying order that we have used here is based on the seminal work of Christopher Sims from 1992, where they use commodity price index to solve the price puzzle using these five macroeconomic factors. Now, in this ordering, commodity price is placed in such a way that it responds contemporaneously only to interest rate and exchange rate shock. All the data, they are stationary in nature because we are taking the national log and first differences. Then bar system is stable, and we have also shown the correlation between the errors of all the variables, and there's no high correlation. Then coming to the results of the study, we see here that the significance of WACR, or the weighted average call rate, is actually significant for 3 of the base metal futures and for crude oil. Now, coming to the main analysis, I have made a chart of the various decomposition and how the commodity prices respond, futures prices respond to the macroeconomic shocks over a period of 12 months. Now, if you see in the first column, I'll just give an example. If you see the red one, the ones that are highlighted in red, that figure shows that to which variable they react instantaneously and the most. That is the WPI for copper, for example. And the green ones in the column show that cumulatively over a period of say 12 months, which ones are affected the most. So here, we have similar results for both precious metals and for the energy commodities. I will discuss the results in details. So in the base metal sectors, we see the past shock of all the commodity futures account for 90% of variance because most volatility comes from their own past shocks. And we see that unexpected changes in interest rate has the highest contribution for copper, zinc, and lead. Now, exchange rate has the highest impact on aluminium and money supply for nickel. Now, maximum impact does not occur contemporaneously for all the variables, for all the commodities. In some cases, it happens in between second and the third period, that is within the span of 3 to 4 months, and stabilizes mostly after the fourth period. In the precious metal sector, we see that unexpected changes in the exchange rates have the highest contemporaneous impact on the variability of the futures return. However, this impact persists over a longer period of time only on silvers, and gold usually reverts back. And shocks to WPI have the least impact on the variance on silver futures, but most on the gold futures. And this also highlights the use of gold as an industrial in the industrial sectors as well. Now, coming to the energy futures, we see that exchange rate shocks have the highest contemporaneous impact on the variance of energy futures. And the sharpest rise of variance of crude oil futures returns happens in the third period, as in the third one. Now, we also see that for the energy commodities, the least variance comes from their own shock, as in if you compare all the commodities, crude oil and natural gas futures are the most, only crude oil futures is the most affected by other macroeconomic variables compared to all other commodities. Now, showing the inverse response analysis, I'll just summarize them. These are the inverse response graphs. I've highlighted the red ones as the response to the monetary policy. And to see, we see a mixed kind of response in between the commodity futures. Now, if we see, copper, zinc, crude oil, natural gas have a positive relationship with shocks in monetary policy, whereas aluminium, nickel, and lead have silver and natural gas have inverse relation. Now, this shows that not all the commodities react alike to the macroeconomic futures. They all depend on sometimes because they are commodity producing sectors also, and they are commodity consuming sectors also. So the reactions may vary for both the things. So there is no unison in the response. Now, we have done an additional analysis where we also checked with the import and export statistics of these commodities. The data is taken from CMI database, and we see that net imported commodities are mostly affected by exchange rate, whereas the net exported commodities are more affected by the interest rate shocks. We see a similar kind of trend in the inverse response analysis also, where this shows this is most likely possible, as mentioned in the overshooting theory of Frankel, that sometimes monetary policy can impact the production decision of a firm, for example, a refiner or for someone who is importing or someone who is storing petrol, for example. So monetary policy decisions can affect his investment decisions, his extraction decisions, his production decisions. And that might have an impact, and different impact for someone who is buying a commodity and for someone who is consuming a commodity. So to sum up, we see that base metal sectors actually have the highest sensitivity to monetary policy, and energy futures have the highest response to the exchange rate. Now we also see that there are other factors, for example, ease of supply, elasticity, etc., which can affect the commodity future prices, and is being not discussed in this study. So yeah, it's done. And just the last slide is policy perspective from this, just one line. We can infer from our study that when designing and implementing the monetary authority should take into account the diverse nature of the responses of commodities across the groups. Because for instance, if an interest rate hike aimed at counterbalancing the effects of a rise in metal commodities, they can also have a destabilizing effect on the food prices. Hence, it is a tricky and challenging area, given the diversity of factors affecting the commodities. And an additional observation, we see that financialization, as it would have the impact across the global commodities globally, that is not found in that extent, and Indian commodity market is still sensitive to the macroeconomic futures. That's all from my side. Thank you. Suggestions, please. Okay.
So, thanks, Saishree, for giving me this opportunity, which is part of this conference. It's next paper. The context and the study very well very clearly, and related linkages between the macroeconomic variables and the commodity future prices, how they are being over the differential. I mean, as over a period, the differential as well. Yeah. So, however, the good paper maybe that you always go for so few points of suggestion, comments that first of all, your idea of starts with financialization, because you are assuming there is already financialization of commodity futures. Inherently, you have assumed, because everywhere you are saying that's the reason you are not talking about fundamentals at all. You are talking about only monetary policy variables, macroeconomic variables, and monetary. So, as an introduction, maybe you bring up that point for primary focusing on monetary policy. So, then how do you think there is a financialization at least in your mind, if there is? At least you can examine some data, or you introduction. And second thing about you have taken all the kind of agriculture.
I was looking, there was a bit of discontinuity of data. Sometimes for a longer period, like 1 year or 8 months. So we cannot.
The policies, I was in policies for most of the except for the recent. I mean, only yes, a few months back. Only until then, soya has already been there. Only I think policies were getting to be discontinued. So if then you give an explanation there, why you have just abruptly selected other categories and not taking the second, right? So you can just give the justification if you have. And so another important thing is that, especially when considering your the reserves particularly respect to
many other commodities, especially gold, you found no relation between interest rate and gold. That's pricing, right?
Actually, it was a very complicated result, and we are
Yeah, so point here is that so you have just taken a period of course. I'll give an example. In the beginning description as well as in the finance also you're seeing there is negative. Yes, there is a negative relation between the interest rate and then the rate or you so, but not across periods, right? So you need to identify events and periods. For example, before financial crisis, when it touched $147 that was the record. So at that time, even interest rates were highest, right, in 2008. So they were together, and now even after that, also post post 2009, so both of them came down. So that's not negative. All the commodities are back. And same now. The during crisis period, COVID. So you have to divide from take the events into consideration and the period. So that's one thing. Yeah, so in that context, I was thinking you could have extended, especially when you're talking about low interest rates and then increasing commodities. That's exactly what's happening right now because of high liquidity. Everything is going up. So those are my points from the reviewer. So I just read out, we provide some more details of background and financial condition. Same thing I just pointed out. And especially short review commodity prices, especially of the base method since early 2000s, which has led to financialization of commodities through the rapid development of futures in the various markets. And investors in these markets, banks, institutional investors, insurance companies, pension funds, and individuals trying to optimize risk return profiles of their portfolios. So index trading the various markets. So the financialization part will highlight. So empirical analysis section may provide the relation and reasons for findings. So some of the like 2 lags and some kind of example, the optimal lag response of particular pricing. Then the mention why it should be. And moreover, why a particular commodity is dominant in various consumption analysis behavior. And please elaborate more on policy implications. It's a good paper.
No.
Now the floor is open for questions, and we already have one online question. The question goes like, what is your brief on macroeconomic and its variables? What is please brief on macroeconomic variables? So I have used 5 macroeconomic variables in this study. Those are the Tulsi price index, industry mix, index of industrial production, then there's weighted average call rate, then there's money supply, and then there's real effective exchange rate. These are my macroeconomic variables, and they're based on extensive literature. Are there any more questions?
The title says, are the commodity futures sensitive to monetary and related macroeconomic variables? As far as I know, the pricing of futures is based on the interest rate as well as the exchange rate. So interest cost of carrying is interest rate. And when it is import and exports are taken into consideration, exchange rate is obvious. If change, when we expect that change in interest rate and exchange rate to be there, it is obvious that future price is going to change. Do you have a doubt or question that are the commodity futures sensitive? It has to be sensitive. It is sensitive. So there is no question. No question that are the commodity futures sensitive to this. So when you are taking these two, it is obvious it is sensitive. How sensitive they are, yes, you can. Or apart from these two, if they are sensitive towards any other variables, yes, they can understand. If you take these two, because they are the main factor in pricing. So, so little bit of the thinking of so because it shows as if they should not be sensitive and or they are not decisive that they will be sensitive, but it is decisive that we will have sensitive prices. Okay. So I think that was this you should not.
I'll look at it.
The extension of simply as studies shows, Indian commodity future prices are set by international markets. If you are taking the Indian macroeconomic variables, how do you deal the integration effect?
So for that,
How the commodity futures markets are sensitive towards the Indian macroeconomic variables? We have actually futures markets are set by international markets. Okay, if you are dealing with the Indian macroeconomic variables, if you want to show that how the Indian future commodity futures markets are more sensitive towards those macroeconomic variables, also getting the interest rate.
Take as control. These two controls and
Now we move forward to the systemic presentation. I would now like to call upon Sonia Garg to present. Sonia Garg, have you joined? Is okay, Sonia, you can share your screen. Now, Sonia Garg, I would please like to request you to start your presentation, or else we can move forward to the next one. Now, I request Darsha. Let's quick present the paper. Kithsiri, Samarakoon. Thank you so much for sharing your screen. Please unmute yourself and start your presentation. Sonia, please unmute yourself, start your presentation.
Yeah, is my screen is visible?
Yes, yes, yes.
Yeah. Good evening, good afternoon, everyone. Myself, Sonia. Myself, Sonia. I am a research scholar. I am pursuing my PhD from Haryana School of Business, Guru Jambeswar University, Science and Technology, Hisar, Haryana. These are the contents of my presentation. I would like to start with the quote of Thomas Jefferson: "Agriculture is our wisest pursuit because it will, in the end, contribute most to real wealth, good morals, and happiness." This quote fits to almost economies in the world, especially to the economy like India. Indian economy is an agrarian economy. Almost 2/3 part of the population is based rely upon agriculture directly or indirectly to earn their livelihood. Agriculture sector provides employment to the approximately 52% of the total workforce. Moreover, agriculture sector significantly contribute in the exports from India. Agriculture and its related products contribute around 38% in the total exports from India. All these things shows the importance of agriculture sector for the Indian economy. Commodities were basically developed for the protection of farmers from the risk arise due to the time gap between the crop sowing and crop harvesting. But nowadays, commodity markets are emerged as a separate asset class for investment all over the world. That's why the commodity market has been receiving considerable attention from the researchers globally. Due to high volatility in commodity prices and highly fragmented markets, it become very challenging to ensure a fair and remunerative price for various commodities for Indian farmers. Although Indian government has taken many reforms like fixation of minimum spot prices of various commodities, in addition to demand and supply scenario, agriculture commodity prices are influenced by many factors like weather conditions, seasonality, etc. Studies including Kritika et al., Jorder, Srinu et al. Also suggested various factors that influences prices of agriculture commodities. Imbibing the macroeconomic related information in the market may safeguard the commodity prices from the effect of those macroeconomic factors that may directly or indirectly influence the commodity prices. Further, the analysis of commodity factors that could influence the prices of agricultural commodities would be of significant interest to market participants like trader, investors, portfolio managers, government machinery, and agriculture community. Due to the importance of agriculture commodities to the Indian economy, the current study attempt to explore the influence of macroeconomic variable on agricultural commodity future prices. These are some key studies related to my area. Garg and Narwal investigated the impact of four macroeconomic variable on commodity indices and concluded that VPI, interest rate and exchange rate were the major macroeconomic variable in the long run. Index of industrial production, wholesale price index, interest rate were the major macroeconomic variable in the short run. Bondanwala et al. 2021 investigated the impact of three macroeconomic variable on two agricultural commodity, chana and soybean, and found that shocks in foreign exchange rate can be used to forecast commodity prices. Also found that crude oil prices and agriculture commodity prices don't influence each other. Nandru 2021 examined the impact of four macroeconomic variable on four agricultural commodities, including four commodities, including one agriculture commodity, namely cardamom. Found that only exchange rate has significant relation with cardamom, and other macroeconomic variable have insignificant impact on cardamom. Kirithiga et al. 2019 examined the impact of three macroeconomic variable on 19 commodities, including both agriculture and non-agricultural commodities, and suggested that macroeconomic variable have to be imbibed in the market for better performance. Jordan 2018 examined the impact of 5 macroeconomic variables on the commodities that belongs to oil and oilseeds category, and found and concluded that GDP, consumer price index, and index of industrial production have a significant impact on price volatility. The sole objective of my study is to analyze the influence of macroeconomic variable on commodity prices in India. The variable of the study, 7 commodities are chosen to represent the agriculture sector. The selected 7 commodities are categorized as cotton and kapas from fiber category, mentha oil from oil and oilseed, cardamom from spices, chana, guar seed, and wheat from grain category. Taking cue from the prior literature, 5 macroeconomic variables such as inflation, GDP, interest rate, exchange rate, and stock market prices have been taken into account. The monthly future prices of cotton, kapas, mentha oil, and cardamom have been acquired from the MCX official website. Future prices of chana, guar seed, and wheat have been gathered from the NCDX official website. The data of inflation, GDP, exchange rate, interest rate have been compiled from a handbook of statistics on Indian economy, RBI. The data of Nifty 50 index prices is obtained from the website of National Stock Exchange. This study has taken the period from January 2011 to March 2020 for all commodities except cotton, as the data of cotton is available from September 2011. The data is collected before the crisis of COVID-19. The study has used the following tools. Descriptive statistic unit to test is used to check the stationarity of the data. The data in models with long time series, one way to improve the model appropriateness and measure of statistical fit is to capture the structural break in the data. That's why Bay-Perron multiple break-even test has been applied. Finally, I applied Ardl model. Ardl model, if the series of the variables are integrated at different orders, that is integrated at first difference or integrated at level, then Ardl model is superior to determine the long run equilibrium relationship among variables. The Ardl model developed by Pesharan et al. Has several advantages as compared to other technique. First, Ardl model is sufficient for small sizes. Second, it can be used when all the variables are stationary at level, or all the variables are stationary at first difference, or some of the variables are integrated at level, or some are integrated at first difference, but none of the variable must be stationary at level 2. Third, it allows us to explore the short run and long run relationship among the variables of the study. Fourth, Ardl model has the ability to use legs for variables. Following the data properties and several advantages of the model, this study employs Ardl model to explore the relationship between macroeconomic variable and agriculture commodities. This is the Ardl model which we specify for our commodity. These are the results of unit root test. As we can see from the table, that all the variables are stationary at first difference except inflation, kapas, and wheat. These are integrated at a level. Thus, the result shows that there exists mixed order of integration which validate the application of Ardl model. This table shows the results of structural break test. The following structural break are found in our data. For the structural break, dummy variables are created and included in the model. The dummy variable is assigned for each break date in the model. Dummy variable is set equal to 0 before the break point. The dummy variable takes the value of 1 for the break point and afterward. Table 3 shows the result of bound test. As we can see from the table that all the future prices of all the commodities are co-integrated with the macroeconomic variables.
So you have to wind up within 2 minutes.
Sorry.
You have to wind up within 2 minutes now.
I'm not getting.
I request you to wind up within 2 minutes.
Table 4 shows the result of long run coefficients of the Ardl model. As we can see from the table that cotton is impacted only by GDP. As India is significant producer of cotton and it is used as a raw material for producing a variety of textile products. As we can see from the table, kapas is influenced by inflation, interest rate, exchange rate, and stock market prices. Because kapas and its various byproducts are traded in the market and are looked upon as an important means of investment. Mentha oil is impacted by inflation, exchange rate, and stock market prices. Because India is the largest producer and exporter of mentha oil, it is also used as raw material in various industries like pharmaceutical, fragrance, etc. Cardamom is influenced by none of the macroeconomic variable. The possible reason may be the production of cardamom. 90% of the production of Indian cardamom is used domestically. As we can see from the table that chana is influenced by inflation and exchange rate. As India is a major importer of chana. Guaseed is influenced only by GDP. Because India is dominant producer of guaseed by producing about 80% of the world production. Wheat is influenced by inflation only. As India is one of the major producer of wheat and it is highly consumed domestically, inflation has positive impact on future prices of wheat. Table 5 shows the result of short-term coefficients of variables. As we can see from the table that the error correction term is negative and significant in case of all commodities, which shows the
Time is over.
which shows which measure the speed of adjustment must be negative and statistically significant in order to establish long run equilibrium. The coefficient of ECT term with respect to all commodities is found to be negative and statistically significant, which implies that the speed of adjustment is taking place at a magnitude of 23%, 68%, 33%, 26%, 15%, 10%, 53% for cotton, kapas, mentha oil, cardamom, chana, guaseed, and wheat respectively. The results of short-run coefficients showed that GDP and interest rate are the major macroeconomic variable that impacted the mentha oil in the short run. Inflation and stock market prices are the major macroeconomic variable that impacted the chana in the short run. Stock market prices and GDP are the major macroeconomic variable that impacted the guar seed. Hanji. Okay. Now I would like to conclude. The major findings of my study are macroeconomic variable have considerable impact on future prices of selected commodity. However, the influence of macroeconomic variable vary commodity to commodity, and it also varies in the short run and long run. This is all from my side.
Sonia, can you hear me?
Yes, ma'am.
Yeah, it's a very good effort. You have written very well. Probably is good. You have justified why you have taken agricultural sector, but then you have taken representative of agricultural sector as initial paper was only 4 commodities for which I have received, which has cotton, kapas, oil, and carbon. Now your presentation shows more commodities. Can you go back to your commodities list page? In your presentation.
Ma'am, it may be the updated version of my paper according to the suggestion of the reviewer.
Could you go back to the page where you have listed commodities which you are studying?
Ma'am, please pardon.
In the presentation, you have
Yes.
just given us. Could you go to the slide where you have given a list of commodities?
Yeah, ma'am. Sure, ma'am. Yes, ma'am.
Yeah, so see, you have included, you are saying, subsequently there are more commodities, you are saying?
Yes, ma'am.
Yeah, okay. So even then, oilseed menthol is not an oilseed. Oilseeds are soya, soybean oil, and then mustard oil. All these are oilseeds. Okay. So first of all, why you have chosen these commodities? Either earlier 4 or it's we need to explain why these 7 you have chosen.
Ma'am, mentha.
And the cotton and kapas, what is kapas, your understanding? Do you know what is kapas? No.
Pardon?
Basically, it's a seeded form of cotton. Okay. After removing seed, it's cotton grain. Basically, both are cotton only. Okay, this cotton, we call it a product. You have taken this lake, we have generally referred to as, and that's also called jade cotton. And kapas is the raw cotton which farmers harvest and bring to the market. So both are saying, okay, there are different products, but then it's the same commodity. You understand? So what I'm trying to say is when you're taking a representation of certain commodities, selecting them as a sector for the agriculture sector as a whole, now you have classified them in the classification also known oilseeds. Menthol is not oilseed, it's an essential oil extracted from menthol leaves. Okay. So,
yeah, ma'am.
cardamom is okay, and then grains, okay, you have taken, and yeah. So these 2 things, and then so that's why your understanding, and you need to provide justification why you have chosen these commodities. Okay. And then why you have choosing the agriculture commodities you have mentioned, but why first of all, like ma'am was earlier referring to, why do you want to study first of all this particular topic? Why? What is the outcome of it that movie is going to help? That's important, right? Or it is just for an economic exercise. So otherwise it will be just an experiment. That's one thing. So can you justify or like add later on? That's also fine. That's a feedback. That's maybe a time constraint we have. Hello.
Yeah, ma'am, there are very few studies are available on agricultural commodities in regard to India, and
that's not just okay. Just so it is not available. So everything you are saying. Okay. Okay. So moving on. I'm talking about justification selection of commodities. It's not particularly a representation of agriculture. So and then what is the period you have taken?
Sorry, ma'am.
Yeah, your period, yeah, initially you are taking from 11 to 20, right?
Yeah, ma'am.
Yeah, so it's the same period. Have you divided the period? Something you are saying break and now you are able to, because earlier period it's not, which we have seen. Have you divided the period or the full data you have used?
Sorry, ma'am.
It's okay. Okay, so I was thinking the period you have taken 2011 to 20, right?
Yeah, ma'am.
So that's consistent. You were saying, you said dummy variable you have used in your presentation. So what is it for? What did you use the dummy variable for? Okay, so you can understand it. Okay, coming to the next thing, you see you are taking IIP, not GDP, right?
Yeah, ma'am.
Why do you keep writing GDP everywhere and your interpretation says increase in income, so they are going to buy more such products, so your prices are increasing. That interpretation is not correct. So it is just industrial production, one part of GDP. Right? You understand that point?
No, ma'am.
Okay.
I'm
So,
sorry.
it's okay.
Yeah.
Give you feedback, you can note down and then.
Yeah, ma'am.
Okay. So, so you have taken IIP on GDP, so you mention accordingly, and your interpretation should be accordingly. Okay. So
Yeah,
it's not the reduction, industrial output. It's a quick estimation that will.
Yeah, yes, ma'am.
Okay, so a few comments from reviewer. I will just read them out. So there is no mention of structural weight in the data. That should be done to detect structural weight in the data. Okay?
Yeah, ma'am.
And the second point is, here GLS testing superior test and have no power in design unit should, it should be done. And the third point is Ardl should include more commodities, soybean, coriander, gram, cashew, etc. in the study. So because initially your paper had only 4 and that too one commodity, and cotton is 1. So effectively there were only 3 commodities. So
yes, ma'am.
So
Sonia.
Yes, sir.
Questions for you. One from your write-up, where it's how portfolio managers are going for portfolio diversification using these multiple commodities.
Yes, sir.
SEBI registered portfolio managers or portfolio managers in general?
Sir,
specific observation with respect to SEBI registered portfolio managers, so I just thought to clarify on that point.
Sir, portfolio managers can invest according to the impact of macroeconomic variable on various commodities.
You're not answering my question. You're talking about SEBI registered portfolio managers or portfolio managers in general?
Portfolio managers, sir.
Okay, fair point. So you are suggesting that they can have this these commodities as an asset class for investing on behalf of the clients, right?
Yeah, sir.
Second point, just a line prior, you said that policymakers can develop appropriate strategies for the reduction of negative influence of macroeconomic variables on the Indian commodity market.
Yes, sir.
You're talking in general. Any specific point you would like to highlight for policy point of view? Okay, fair point. Last question for you. You have talked about correlation between stock prices and commodity prices, and you said that a negative relation is expected to be there between the two.
Yes, sir.
In that?
Sorry, sir. Please pardon.
In your paper at point 1.15, you said that on the basis of these evidences, a negative relation is expected to have between stock market prices and commodity prices.
Yes, sir. Yes, sir.
later and how you have come to this conclusion? I just need a detailed explanation from your side on this point. Can you explain, please?
Sorry, sir.
No problem. It's okay, fine.
Yeah.
We can move on to the next question. Thank you. Thank you for your help.
Thank you, sir. Thank you, ma'am.
So we are now open to questions and first.
Hi Sonia, I have a question. Quite observation about the research. Especially,
Yeah.
I don't know, Tulsi rightly pointed out this conceptual. But in this kind of the time series, by nature it is having a certain traits that you apply the roundness to. So, I would suggest you also see the abnormal returns and observe the operation of this. How performing the differences between
one more observation. I think in your model, you are writing changing the interest rate and changing the. But in the analysis, you are putting only interest rate and all. Just correct it. Your model says whether you are taking change in the interest rate or you are taking interest rate and GDP etc. Your model says it is change, but your analysis says it is interest rate, GDP etc. What you showed in your PPT, it was change in interest rates, the model. Okay, if it is you can correct your observations or you can whether it is the model you have to correct it or in the analysis you have to do. I don't know whether you have taken it correctly or not. Thank you.
We can move on to the next presentation. I request Darsha, Wickramaarachchi, President.
Hello, am I audible?
Yes.
Hello,
Yes, you are audible. Please go ahead.
good evening everyone. I'm Darsha Wickramaarachchi. Our research topic is application of geometry Brownian motion model and binomial pricing model for simulation and hedging crude futures in Indian context. Outline. In this presentation, I'll continue with introduction, research problem, research objectives, literature review, conceptual framework, methodology, operationalization, findings and discussion, limitations and references. Let's move to the introduction. In this study, we have basically focused on crude and futures, derivative markets, geometric Brownian motion, binomial pricing model, and multi-commodity exchange of India.
Hi, can you just repeat your introduction and highlight your findings and conclusions?
Sorry, ma'am.
Yeah, and then can you just be a little louder? Yeah, because it's not very clear. Okay.
Sorry, ma'am. I can't hear clearly.
You can't hear me? Hello?
Hello?
Yeah, please go ahead.
Hello?
Please go ahead.
Okay, ma'am. Introduction. In this study, we have basically focused on crude oil futures, derivative markets, geometric Brownian motion, Binomial Pricing Model, and Multi-Commodity Exchange of India. We know recently crude oil prices are fluctuating unexpectedly. So, it is highly required to identify accurate simulating and hedging models for crude oil prices volatility. To cover this gap, we have applied GBM model and binomial pricing model to test those models' validity to forecast and hedge crude oil price volatility. GBM model is one of price forecasting models. Binomial pricing model is one of hedging models. When we focus to India, India is the third largest crude oil importer in the world, which has a derivative market. In India, there are 4 markets which are called as PSC, NSC, MCX, and NCDX. NCDEX is a market which trade agri-commodities and not trade crude oil, but PSC, NSC, and MCX trade crude oil. BSC and NS is just started to trade crude oil and no sufficient data to analyze for years, but MCX has sufficient data to start it in 2005. So we mainly focus to MCX. Research problem. The GBM and binomial pricing models are widely used globally for crude oil price movement, prediction, and hedging because of the higher accuracy and interpreting result. But Indian users of the GBM and binomial pricing models are not widely observable. The solution that in that study is focused on how the GBM and binomial pricing models used to predict and hedge crude oil futures daily prices of MCX in India. Research objectives. The main research objective is to forecast and hedge crude oil futures prices using GBM and binomial pricing models while achieving following sub-objectives. Provide information for investors to make investment decisions, measure the accuracy of result with actual data, compare actual result with the forecasted price, and draw down graphs to measure the model's accuracy. Determine the effectiveness of using the GBM and binomial pricing model. Literature review. The Brownian motion is one of finding of the biologist Robert Brownian. After his finding, most of researchers studied it and improved it. In 2004, Singapore studied the GBM and presented its assumption as well as suggested the features for security prices. Those are highly applicable in modern researches and situations. The binomial model initially came out as a result of Coase et al. Findings in 1979, and it also improved by several researchers. In 2017, oil price using GBM and use single-step binomial pricing model to incorporate risk-neutral profitability and option pricing methodologies to hedge against oil price declines. Here also, they prove that the accuracy of GBM and binomial pricing model. Conceptual framework. This is the conceptual framework of our research study. Crude oil is an unprocessed petroleum product composed of hydrocarbonic deposit and other organic components that grow organically. GBM is a continuous stochastic procedure in which the logarithm of the randomly fluctuating extended escort and Brownian motion with drift. Binomial pricing model could be used incrementally, allowing for specification of nodes for different contexts between the valuation date and options expiration date. Simulating the price of security means generating a price path that security may follow in the future. Hedging implies that offsetting the risks of any adverse price movement. Methodology. The research approach was used in this research study is quantitative research approach, and we have collected secondary data which was extracted from MCX website. The sample size was daily crude oil futures prices of crude oil futures in MCX from 2005 to 2016 years. GBM and binomial pricing models were the data analysis approaches and accuracy measurement methods, MAPE, sensitive coefficient values calculated from divergence software. operationalization. GBM model is a method for estimating value at risk, and in this technique, the random variable quantities logarithm follows a Bromian motion with drift. The winner process is the name given to it by satisfying the following statistic differential equation 1. Under GBM model, we have to find change price, and there are two components called as deterministic component and stochastic component. When using Microsoft Excel build-up model, we can calculate simulated security price equation, and finally we have shown it as equation 2. Binomial model. This is the two-step binomial tree. Considering this two-step binomial model, we can improve it for n period. Here K indicates strike price, which was 3,520 rupees on 31st December 2020, and exercise price was average price of all daily prices 2,952 rupees, and risk-free rate was average Indian RPU rate. Findings and discussion. This is the graphical figure for actual crude futures price for MCX from 2005 to 2020. It implies that from 2005 to 2020, actual crude futures daily prices went up and down, fluctuated. MCX recorded the lowest actual crude futures price on August 17, 2005. It was 28 rupees. The second and third lowest price were recorded in April of 2020. They were 955 and 957 rupees. This is a kind of familiar situation which happened near past. The crude oil price dropped in WTI was recorded as a historical note. MCX reached its three highest actual crude oil futures price in August and September 2013. They were 7,571, 7,402, and 7,365 rupees. This is a graphical figure for simulated crude oil futures price of MCX from 2005 to 2020, which was calculated by using GBM model. Even though this graph shows the simulated prices, which was calculated using GBM model, it shows that MCX recorded its lowest simulation crude oil price futures price on August 17, 2005, like actual situation, and that simulated price was 29 rupees. There was only 1 rupees difference. Likewise, the simulated crude oil futures prices identify MCX lowest and highest price like its actual prices. The important point which we should consider here is that the crude oil price drop in WTI were also identified in the GBM model. When compare both actual and simulated crude oil futures prices, we can see this kind of graphical figure, and it shows that both actual and simulated prices have not any considerable difference because both lines are continue together. This is a sample table extracted from crude oil futures price simulation table in our research study, and when calculate its MAPE value was 0.106535. When focusing MAPE judgment of forecast accuracy, if it is less than 11%, it is highly accurate. If it is between 11% to 20%, it is a good accurate. If it is between 21% to 50%, it is reasonable forecast. And if it is higher than 15%, it is inaccurate forecast. Since the MAPE value are between 0% to 11%, it proves that GBM models validity to forecast crude oil futures price on MCX. Under the binomial pricing model, we have used divergence software and calculate option prices for several years and by considering several steps. However, divergence software shows binomial tree only for 10 steps and shows result up to 500 steps only. This is the binomial pricing model tree with 10 steps for 1 year. This is the divergence software result for 1 year, which with several steps. Here we can see each and every sensitive coefficients values are less than 0.5. Likewise, next slide will show binomial pricing models tree for several years and Ravagen software result for several years with several steps. Since time is limited, I'll go through it quickly.
Ma'am, your time is over. Conclude
Okay.
with moderate.
Sorry.
You have to conclude with 1 minute, your time is over.
Conclusion. Conclusion and recommendation. The GBM model is applicable to forecast crude oil futures price on the multi-commodity exchange in India with MAP values ranging from 0 to 11%. The sensitive coefficient values calculated from Ravagen software in this study are less than 0.5, which means the binomial pricing model also is applicable to hedge crude oil price variance. This research study expected support investors and other stakeholders in making wise decisions about crude oil futures trading, particularly on the multi-commodity exchange derivative market. Also, this study will be helpful for future researchers to advance these models by focusing on other derivatives market based on different underlying assets. These are the references which we have referred for our study. Thank you for your kind attention.
Thank you, Darsha. Can you go back to your register and can you tell us what is the source exactly you have collected data from? Hello?
Madam, hello. Miss, your voice is not clear for me.
Can you hear me?
I can hear.
Yeah. So, what is the source of your data? Have you collected from M6 website?
Yeah, ma'am. From the NCX website.
MSIX. How did you collect? Which reports you have downloaded?
Sorry?
From which reports you have compiled the data? You are taking daily data, right?
I collect crude oil futures prices.
I'm sorry. See, could you
collect.
go back to your chart because there is a mistake in your data. That's why I'm asking you. What is the source to start with?
You mean, madam?
Yeah.
Software result.
Go to the chart one. Yeah. First one. Yeah. Okay. Go to the first one. Start.
Ma'am, in the NCX website, they present crude oil prices for 100 barrels. Hello?
Yeah. First.
I have converted them into for 1 barrel.
No, price is quoted per barrel only, not for 100 barrels. The trading lot is 100, but not the price is quoted. Price is quoted. Yeah, so I mean, whichever it is, you go back to this.
Please go to the first chart.
First chart.
Yeah, so
literature review. Did you mean literature review chart?
First chart.
First chart you have moved ahead. You have only 3 charts, right? From the first chart. Yes, that one.
This one.
Anyway, so the draw point which you are mentioning in your text as 28 rupees, that has never been the case. That was 2,700 less, close to 2,800. So it could possibly be a typo, and even the April minimum, you were talking about April 2020. So minimum was 900 something. So actually the 1 rupee, when the prices went negative, the price sensitive was at 1 rupee. So even now today, if you check on the Bhav copy of those dates, you will find the same price. So that's why I'm asking you from where you compiled, either the source is wrong or your compilation is wrong. Please check.
That's what I'm trying to understand. So how you collect the data? That's why I asked you which report. So they on our website, on the NCX website, the prices are available in the hard copy, either in contract wise or day wise. So that's the source you can compile. If you are taking from Bloomberg or some other sources, sometimes while extracting, you tend to get some the wrong data. It could be one possibility, or while compiling one by one, if you have done while loading hard copy, then you must have made a mistake in compilation. So that's the thing. Basically, there are errors in the data you need to check. Second thing is that the title of chart is MCX, is price for MCX or derived features. You understand what I'm saying? So the source is MCX. If you have taken from MCX website, if you are sure about that, then you write below the chart source as MCX. Okay, so it shows that it's MCX stock price. It appears like MCX price. Do you understand what I'm saying?
I can't hear properly, ma'am.
Okay. So, title of chart should not be MCX. That's what we are trying to tell you. And then the other was the mistakes in your data will be used.
Please put on the mic there. Please don't do the mic.
Okay. So, can you hear me, Darsha?
Yeah, now I can hear clearly, ma'am.
Okay. So, what I was trying to tell you is, so there are mistakes in your data. So either it could be while compiling, it must have happened, or while extracting the data if you are using sources like Bloomberg and all. So sometimes it happens. So which data source you have used, I asked you earlier. You have collected from M6 website?
Yeah, ma'am. I have collected those data from the MCX website, and
which reports you have used? How copy?
Excel sheets. They have provided the Excel sheets.
Okay. Okay. It's all right. So please note that since we are running out of time, so you check your data. There's definitely errors in the data. You need to check the data, and then while mentioning if the source has MCX, if you have taken from the MCX website, not as the title of the chart as MCX. Okay. It's a Crude futures price, right? Not MCX price.
Sorry, ma'am.
Yeah. Are you able to hear me? Okay. Yeah. So, okay. So then, two comments. Can you hear or not?
Yeah, ma'am. I can hear now.
Okay, so there are two more comments from the reviewer. Methodology it would be good if introduction is reduced and the implications made more forceful. Okay, that's one feedback you have got. And so from my side, I explained. I hope you have heard. And one last point I would like to say is that we have done an empirical exercise, leave about the errors apart of the effort, but then what is the outcome of it, or how one can use it? You are saying an investor can use, or hedger can use for hedging based on this model, generating options, premiums, and then based on that one can hedge. So that point is not very clear. So if you want the paper to be useful, you need to correct the data first and then give some implications how one can use your model in the practical point of view, because we are practitioners. So we would like to see how one can use it. That will be like end user of your the good work you have put in. Thank you.
I have reservation towards your technology because you have used an option pricing model and you are talking about futures. And even I see in your model you have told about the stocks. the call up or call down, binomial pricing. So the model itself, I have reservation to accept it. And another thing is, these are the pricing models. Yes, they can help you in hedging or whatever it is to avoid risk, but they are not the hedging models. They are just pricing. You can forecast by the help of binomial method. It is not binomial pricing what you have used for, and even in your models, many places you have told option price, in result you are mentioning option price. In the model itself, you are talking about the stock price. I think as a researcher, you have to be very careful about these things. Somewhere you write, say, on stock price, somewhere you write commodity price, somewhere you write auction, somewhere you write futures. These type of big mistakes should not be there in your paper. Right? Be careful, and this is actually the model itself. I don't accept, because call upper, call down, price upper, price down will be your option pricing, and the future pricing is something different. And you can how do you take this into consideration? I don't understand. I mean, yes, you use some method for forecasting of commodity price. Yes. But I think you have to check your methods. Thank you.
Good evening, ladies and gentlemen. It has been such an honor to be a part of this wonderful event. On behalf of SEBI and NISM, I would like to extend my heartfelt gratitude to our esteemed paper presenters, chairs, and discussants. And sincere thanks to all the attendees and participants, both online and offline, for making the time to be with us and helping us make this event a grand success. Now, I request Mr. M. Krishnamurthy to present a token of appreciation to our honorable chair, Naveen Sharma, and Dr. Tulsi Lingareddy.
Just want to say a couple of points on the papers presented in the last 1.5 hours. 2-3 points which I would like to share is that one about is factuality of data being presented in the papers, which is very important. Second is about the time management. If we focus more on the running of slides and not covering the subject, that may not give you the absolute or optimum, I'll say, understanding of the subject among the audiences. And third and foremost, it's better if you have less number of slides and more of a discussion rather than more number of slides and trying to cover more slides in lesser time period. So that's something which you should remember. Since you guys are doing a very good job, we are putting in hard efforts, we are collecting data, analyzing that data and coming out with some very good suggestions. But at the same time, these points needs to be kept in mind, and I'm sure next time, whenever you are going to give papers, present your papers, share your thoughts, definitely you are going to find the difference. So all the best to everyone. Thank you everyone for being here with us in this session. Thanks a lot for your inputs, feedback. That's really helped, and I'm sure it's going to help the participants as well to improve on their working. Thank you so much.
Now I request Mr. N. Krishnamurthy to present a token of appreciation to our honorable chair, Naveen Sharma.
Valuable comments from a practitioner. For the time and valuable inputs that are in the question.